Type 1 if you can hear me. All right. Now, I want you on a scale of 1 to 10, rate how beautiful that piano playing is. Okay, I would give it a 10. Very good piano playing. Everything's in tune. They know what they're doing. It's sophisticated. It sounds good. All right. The same thing has the same thing you can do in a piano, you can do liquidity. Okay. Welcome to my liquidity masterclass. So, I'm going to explain it using this piano on the screen here. Okay, so you have a piano screen. Now, I'm going to be going to my liquidity pools tier list, which can be found in PDFs and more. And if you go to liquidity pools tier list, you can basically sign up and get it if you want, if you're not on my premium. So that's what I'm going to be basing this off of right now. All right, and I will be going over the liquidity pools tiers list and then bring it all together at the end. All right. So let me pull this up real quick. So here we have our liquidity pools list as seen on the screen. Right, nope, not that. Right here, all right? Now, we have many types of different liquidity pools, okay? And each one has their own meaning, okay? So, if I were to look at this liquidity pools tiers list right now, all right, there's, on this list alone, there's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 things that could be considered liquidity. So, basically, all right, we're going to start with, I'm going to be going over what each one is and then bring it all together at the end. So starting off at the F tier, we have highs/lows that took out another high/low inside of a fair value gap. Okay, so we're going to be going over this one. So using my piano, each liquidity pool is going to be a note. Okay, so this is going to be this note right here. Okay. Liquidity that takes another pool out inside FEG. So this is going to be our first note right here. All right. Now, what is a good example of that? Well, a good example of that would be the gold chart this morning. Okay. The gold chart this morning, we had a one setter for life. It was on the 3-minute, okay, to the downside. A couple of people in my chat took it and it was a loss. Okay, I was not on the chart when this happened though. They just told me that. And it looked like a pretty decent play, except what's the problem with this? You're going for liquidity pool that's a wick that sweeps another wick inside of a fair value gap when the body's never broke it once. Now, maybe if a body broke here, then it wouldn't matter. But because the wick respected it here and here, the wick respects it again here, and the body never closes below. So even though this is a data low, it is now considered a protected low, or in other words, a low that took another low inside a fair value gap. So everything coming down is going to be pretty low probability to target this. Now, I'm going to show you an example. Look at this. We had a 1-minute here, and it got closed below, so it's a good play, right? No, it's a good play, but it's not going to be a clean play. And what you can see happens is we end up hitting the stop loss, and then we go down and hit it later. And whenever you have a scenario like this, these liquidity pools are hard to target because, yeah, you might get some working plays, but you're going to get a lot of stop outs as well trying to target highs and lows like this. Okay, so that is going to be the first one on the list. Probably the least confident liquidity pool out of the probably the least confident liquidity pool. All right. So, yes, this is being recorded. All right. Next liquidity pool on our tier list, okay, or the next note is going to be order blocks. Order blocks are hit or miss. Okay, order blocks hit or miss. Okay, but let me go up to my drawing here, and we're going to be doing order blocks. Okay, so order blocks will be right here. That will be another note. So for those of you who don't know, an order block is basically a candle that I call it's sandwiched between two other candles. So this candle right here would be an order block because it's sandwiched between this green candle and this green candle. Okay, it's sandwiched between both. And the second we close above the opening price of that candle, which would be right here, it is considered an order block. Okay, so literally right here it'd be considered an order block. And you now want to see this used as support. Now, I'm on the 1 minute time frame right now, but could this be on the 4 hour time frame? Yes or no? Yes, this could very, very well be on the higher time frame right now. Now, trick question, is this a change in state delivery? No, this is not a CISD. It's only just an order block. Okay, a CISD, it's typically, I don't even know if you get one here, but a CISD typically will take out a swing low here, like that. Okay. In general, this is just like a trend continuation order block, all right? Every CISD is an order block, but not every order block is a CISD, exactly. So we have support here from a order block, and if this was the 4 hour time frame, this range right here could take a day to hit, right? Right now, we know it's a 1 minute, so we know that's not the case. And a lot of people will be like, oh, well, our draw on liquidity is going to be the support of the order block. And this is very, very 50-50. Okay, so this is why I rate F on the draw on liquidity tier list, because not every single time we will retrace here and bounce. Sometimes we go like this, sometimes we go like this. There's no way of telling. Most times, like, it's not a great draw on liquidity. Now, in this situation, do we end up ever retracing to the order block? Yes, we do, down here. But we retrace after a bunch of BS happened. Okay, so like, not every time this is gonna get retraced to, and there's examples like if I go to the 4 hour time frame here. Okay, if I just show you an example, look right here, this number gets retraced to, right? So sometimes it will, sometimes it don't. Oftentimes, if there's a gap above an order block like this, sometimes we'll just hold the gap and not go for the order block. So like if I'm looking for a short here down to the order block saying, oh, the order block has to hit, don't be surprised if that short fails, because this does not need to hit. All right, because we could just hold the gap. So that is going to be number 2 on the list. All right. The third note on the list is going to be volume imbalances. All right. So basically, an order block is basically the way people see it is an order block is created by smart money, where they basically make the market move, and then sometimes they'll come back down to the order block so they can get out of break even. So basically what they do is they'll like short here, create this giant candle, then we'll go up and they'll push the market back down, and then they get back out of break even, and then this ends up being, so it's like some really weird scientific thing. I don't know. I don't even know, but that's why it's considered a draw on liquidity, or could be. Yeah, they just rebuy here or something. Like, I don't know. It's hard to explain. Don't worry about that. But okay, the third liquidity pool is gonna be volume imbalances. The thing I don't really love volume imbalances. Okay, I'll show you the thing I have against volume imbalances. So we just move here. So we have liquidity takes out this order blocks, and I'm gonna probably end up changing this at the end. But volume imbalances, right? Or in other words, VIs. Volume imbalances or VIs. A volume imbalance is basically a little tiny gap where the close of the candle does not align with the open, and it like gaps up. So when this candle closes, we gap up in like a second, and then the wicks overlap, but the bodies of the candle don't overlap. So this is volume imbalance is. On the 1 minute time frame, they really mean nothing. They just mean there's low volume. Like if I go to the YM chart and then the 30-second chart, you'll see a lot of volume imbalances. You got one here, here, like almost every candle has a volume imbalance. So they don't really mean much on the lower time frames, especially no volume. And that's why I have them at C, because they are more important on the higher time frame. On the 1 minute time frame, 5 minute, they're not that important. But on the higher time frame, if we do form a volume imbalance, oftentimes we will go fill it. Okay, so the daily had a volume imbalance here. What happened? We went to fill it. Daily had a volume imbalance here. What happened? Went to fill it. Daily had a volume imbalance here. What happened? We filled it. All right, so you don't really need them in your trading, but they could be good to look for on like the 4 hour and daily, and I'll show you how to combine them with everything after, because using them these just alone will probably not be smart. All right, but that's basically a volume balance, and I always note them whenever we have them in the higher time frame. Yes, volume imbalances are caused by them sometimes, Zillow. Yep. Okay. Next one, unbalanced inefficiencies. Now, a lot of you might disagree with this. All right, but unbalanced inefficiencies alone are not the best draws and liquidities. Okay. Like for example, here we had a weekly fair value gap here. A lot of people on this candle were targeting that weekly gap. All right, a lot of people last week were targeting this weekly gap, and I get it. I wouldn't have minded if it hit either, but we got a really bullish reaction on the lower time frame, and I was like, okay, this probably won't hit. All right, so sometimes you will see unbalanced inefficiencies filled, sometimes you won't. Okay, it's better to pair these with other liquidity pools, which I'll go over in a little bit. Okay, same thing with this. Unbalanced inefficiency was never filled. All right. Same thing with this. Unbalanced inefficiency never got filled until way later, right? So drawing them and using them alone are not the greatest confluence. All right, you need to combine them, which I will show later. Okay. Okay, let me go back here. Okay, so we got unbalanced inefficiencies. Yes, there will be recording. So we got unbalanced inefficiencies. All right, that's number 4. All right, going to the B tier list, we got high/low inside of old fair value gaps. Okay. This is different than this. This is a high/low that took out another high/low, but it's not actually a... Okay, let me know if that works. But it's not actually a higher low that took out another low or high. It's just a high/low. So what do I mean by that? I call these intermediate term highs and intermediate term lows. So, like this. Intermediate term high / intermediate term low. All right. These are great liquidity pools. All right. For example, today we took out a data wick, right? We took out a data wick. All is fine and dandy. All right. And we are rejecting. What might be a good liquidity target to target now? Well, old highs and lows inside fair value gaps. So on the 3-minute time frame, we have a low inside of an old fair value gap, where the reason why this works so well and why these are great targets and why I target these lows and highs a lot is because what causes the market to go up here? When we bounce out of this fair value gap, what causes the market to go up? Yeah, orders. Orders cause to go up here. Buy orders. So they might not mean anything then, but when we switch and go on the other side of the curve, which if you look in the education section of my market maker models, when we have that smart money reversal, this will be the next important target, because what caused us to go up here, naturally there's going to be a lot of stop orders here, so the market's going to want to retarget that after we get the smart money reversal, maybe up here, right? Okay, maybe we get like a 2-minute IPG. I don't know. This is an absolute banger. I don't know if anyone took this one, but we got a smart money reversal here. All right, close below. Where does the market like the target? Lows and highs inside fair value gaps. So even though the 2-minute, right, this would be maybe a first DP if it was 1R. If it's not 1R, well, then I probably want to target. Let's see if it is. So it was about 0.9R. So, you know, maybe I would have scaled there, right? Because, again, I know it's a good liquidity pool. Now, these are actually one of my favorite liquidity pools, all right? Just because they're just so good. Like right here, we have 3 stacked up highs, and then what's the lowest low? It's a low inside of fair value gap. So naturally, the market's going to want to target this. So, okay, so a lot of people are like, oh, short all-time highs. Okay, short all-time highs. Don't take this. How many people didn't take this because they didn't want to short all-time highs? Okay, I'm going to show you something. Daily review last night in my premium. Listen. Wait. Look. Listen. So, what do I mean by that? We had 2 conditions to work with. Shorts in here, longs in here. Does everyone understand what I just said? We had 2 really nice conditions. Shorts in here, longs in here. And I knew that. Now let's go to the chart. What happened? We opened up inside my long zone, my support zone. That's why I long today. And what happened? We went back up to the short zone. And usually when we have 2 obvious gaps like this, we will not break them both right away. We'll usually ping pong between them. And then like 2 days later, they'll break. So anytime you get a short in here, even though we're at all-time highs, I'd say this is high probability. Anytime you get a long in here, I say this is high probability. And I literally labeled them both in my daily review last night, saying I'll be looking for scalps from each zone. Okay. So, does that make sense, everyone? But you can see how I label that. All right. Now, if this gap wasn't here, then I would never have looked for shorts there. I would have been like, yeah, all-time highs were super bullish. All right. All right. Trend line liquidity with 2 to 3 touches. This is a B. All right. This is a B. Trend line liquidity is basically when we have a bunch of touches on the same trend line. And if I draw a box, okay, if I draw a square, I generally want that trend line liquidity to be like this or lower. Okay, this or lower. If it's above, okay, if it's above like this is bad. This is too steep. You don't want the line to be like this steep. I don't really consider this trend line liquidity. It's got to be at 45 degrees or lower. So like, for example, I like this trend line liquidity, and I think we're going to dump here. See, if I were to draw this on a box, it'd be below the 45 degrees. All right, and all right, trend line liquidity, intermediate term low. Now we're starting to combine the two. So now we have 2 liquidity pool confluences. Not only do we have an intermediate term low, we have trend line liquidity. And this is algorithmic. See how it perfectly touches every time? Right? Perfectly touches. Now, this is probably more like a B trend line, like more liquidity, because we only have 3 touches. If we had like 4 or 5 here, like if we had like this, then I'd consider this higher. But right now, I consider 2 to 3 only B. But you can combine that with an intermediate term low, which might raise the rating of it. All right. A bad example of trendline liquidity would be like this. Like this. Again, only 3 touches, and it doesn't stand out. It's in the middle of the range. It doesn't make sense. It's got to be at the higher or low of the range. So like, this is honestly not a bad. This is actually a decent example. This is gonna be ran at a later date, not right now, but this is gonna be important. We kind of came down here. It looks better in the hourly, for sure, but it still counts like on the hourly. So I like that. This one, bad example. See how there's only 2 touches? I would not care about this. Now, if we had like this, well, then I'd care more about that. Now, what would bring that trend line liquidity from a B to an A? Well, if we had like 5 or more touches. So like if we got this, then this would be really good trend line liquidity. Like I'd be full port short if I saw this. Right? If this was like this, I'd be full port short every day until we hit that. All right. Does that make sense? Does trend line liquidity make sense to you guys? And see how this is not steep? It kind of follows that 45-degree angle a little bit. All right. Really bad example. This is too steep, and this doesn't have enough touches. Bad example. What happens if you see it on both sides? Well, if one's really steep and one isn't, then the one that's not steep is probably going to be more important. So like this right here is going to be more important, even though it's not even that great. Because this is just too steep. Also, the one with more touches is probably going to likely break first. So too steep is bad because it's just not algorithmic. The best trend line traders are trading these trend lines that are like 45-degree angle trend lines. Like if you have a trend line that goes like this, it's just, that's more of an uptrend. That's not really a trend line build-up. That's just a general uptrend. So, okay, so I'm going to write trend lines. Trend line liquidity. All right. We have new week open a gap and new day open a gap. So I'm not going to spend too much time on this, but if you just go type in new day open a gap and new week open a gap indicator, basically what it is if you go to the 5-minute time frame and you go to the gaps from 5 to 6 p.m. every single night or from Friday to Sunday, it's basically, let me see if I can find an example. Like a good example, maybe right here. It's basically the gap in which we close to the open. So if we close, so like right here, we close right here, okay, and then we open right here an hour later. That's the new day open a gap, right? And I don't need an indicator to see this. It's just the close of the candle to the open, and this is a new day opening gap. Okay. Does that make sense how I drew it? Now, these could be as big as you want or as small as you want, right? It just depends on what the gap is. And oftentimes, these will be decent draw on liquidities. So let's say up here, we get a smart money reversal, we get an inverse. Well, then where's a draw on liquidity? Likely this new day opening gap. And it will be used as support and resistance. So we close below it. Okay, it's used as resistance, right? The bigger the gap, the more likely we go fill it. Okay, so this is giant, meaning any smart money reversal, any V-shaped recovery up here, my target might first be this new day opening gap. Okay. Okay, don't really need any further explanation on that. I feel like that's pretty self-explanatory. Yes, this will be on YouTube. Okay. How's my short doing here? Short just hit the liquidity pool. Okay, do you guys see live time example of my final TP hitting? Why would I not target any lower here? Why was this the final target I talked about here? Because there's nothing to target. There's no intermediate term low. There's no good trend line liquidity down here. Right? There's like this, but it's like, again, this is not even algorithmic and it's a little steep, right? So this is where you could look for longs. All right. But yeah, you can see I just called that in live time, right? And when I called it, we had a green candle to the upside, and I bet everyone in chat was like, "Oh shit, he's wrong. We're gonna green candle back to the upside. I'm gonna fade him and try to go long." What happens? Just death candle back down to this low that I said would hit. All right. And the only reason I knew that was gonna happen is because delivery out of this higher time frame gap and 2-minute inverse at the top. All right. So again, that's just me reading liquidity. All right. Okay, relative equal highs and lows. Keyword relative. Relative. All right. What do I mean by that? Well, let me just draw out this. Relative equal highs and lows would be something like this. These are relatively equal. They're not perfectly equal. Okay. These are relatively equal. They're not perfectly equal. Right? See a high here, like almost like double tops and double bottoms. Decent draw on liquidity. They work best on the 15-minute time frame and above. Same thing with here. Relative equal highs. Right? We don't quite tap this perfectly, but it still makes a double top here. And this is likely going to be ran. Okay, same thing with equal lows. Relative equal lows would be something like this. Relative equal lows. Come very close here. A lot of times when you come close and then go back up, right? These are now relative equal lows. Okay. All right. Now, are they like a point difference? Yeah, those are like a point difference. All right. Previous session highs / lows. Pretty self-explanatory. These alone are decent, but they're not the best. So like session range / highs and lows. If I just turn this on, it'll basically mark out London high and London low, Asia high, Asia low. These are great draws on liquidity when combined with something else. So today we had London high was not really a swing high, but Asia high was. All right, and you can actually see London or CPI candle ended up taking out that Asia high right here, and then we dumped. So like they definitely are important. Like they are important because they will react, but they're definitely good with PPI. They're definitely good with other things. All right. Same thing with London low. CPI smack London low. And what happened when we hit London low? We got a long setup, right? So you can see we swept London low, get a long setup. Okay, what's another good example? Here in London, swept Asia low, got a long. Okay. So yeah, session highs and lows. The indicator is just called Sessions Liquidity Tracker, but you know they're decent alone. All right, perfect equal highs and lows. 1 to 3 candles away. On the 1 minute time frame, this looks pretty good. On the 1 minute time frame, if we have perfect equal highs or equal lows, like 3 candles away or less, that's probably A. Like these are like, if we had this right now, I know these would be a hit, and they're perfect. Like let's say this is a perfect draw on liquidity, I know these would be hit. This would be a great first target. All right. Is that self-explanatory? Do I need to do any more explaining? Any time frame, these are good. 1 minute above, generally. Even the 30-second, 3 or more is pretty good. The likely hit. Because It's very hard for a $24,000 index to make perfect equal lows and equal highs like that. All right. All right. Perfect equal highs and lows more than 3 candles away. So let's say we have like this. I know these would hit. Like this is like full port. Next inverse back to these. Right? I know those would hit. All right. Let me do some more explaining. Anytime I say equal lows, equal highs, that means perfect. All right. Another example, like let's say we had equal lows like this, and they're perfect. This would be awesome. Like very far away. It's very hard for a index like this high to do this. All right. Very high for this to do this, because doing this is so rare that like it's a great draw on liquidity, because this is algorithmic. People see this and be like, oh yeah, the market doesn't run an algorithm. Then how the hell would we form perfect equal high or equal lows at 23,917? That's the most random level ever. Like that's how you know it's algorithm. All right. So anytime we get equal lows or equal highs in this on the 1 minute time frame or above, more than 3 candles away, chances are, one, they're probably going to be in the higher time frame too. And the higher time frame, the higher the time frame you go to, the better. If we have hourly equal lows and equal highs like that, those are really going to be, like, those are really high confidence. So, like, let's say we hit this. Like, I know these would be hitting today. Like, if we had this, dude, like, PPI probably would have dumped all day. I mean, we obviously didn't, but. Okay, does that make sense? I trick myself here. All right. And last but not least, data high/low with a giant wick. All right. And by giant wick, I just mean a wick that's obvious. All right. Why'd that fail? Because you faded liquidity. Remember I said we should keep dumping? Okay, data high, data low, very self-explanatory. Right here, very obvious wick. It stands out. You can see it. Like, it's not like it's a normal wick. Like, this is not a normal wick on a candle. No, I didn't. I already went over that. Data wicks are literally just highs and lows formed from 8:30 news events that they're obvious. They can be formed at 10 a.m., but much more rare. Most of the times they will be used at 8:30. So make sure you are checking Forex Factory on Google. Go to the red folder. Have red folder in US on. Filter, red folder, even orange folder and yellow folder is fine. But US only, and these will affect NQ. And anytime you see any red folder news, look for data low, okay, or data high, and do not trade before 8:30. All right. So like today we had PPI 8:30. Look for a data high or data low. Okay. I don't even remember the last data wick we had, but this was one today, so this is the one I'm gonna show you guys. All right. So, as talked about the piano earlier, all right, all these liquidity pools are all a different note, all right? Now, how do you make a song? Well, you have to put all these notes together, okay? And once you put all these notes together, okay, you can create a song. Or in other words, you can create a trade. But using every single one of these by itself is going to be very low probability, okay? Using this by itself, going to be low probability. Using this by itself, going to be low probability. Using this by itself, going to be low probability. Using this by itself, low probability. You need to combine 3, 4 of these, and then that's where you get a trade, all right? And that's where you get high probability. Okay, you can't just use one. So I'm going to go to FxReplay right now, and I'm going to find a random ass example. Okay. And I'm going to try to find one good draw on liquidity. Okay. And I'll explain my thoughts and why. All right, so we are in NQ. Random example, all right? Now, does anyone actually, how about this? Does anyone want to give me a random date? Because this might look like I'm cheating. Someone give me a random date. I don't want to make it look like I'm cheating. March 2023. Okay. March 2023 of what year? Or wait, what day? 4th. Okay, March 2023, 4th. We're going to go to NQ. March 2023. The 4th. Okay, we just created a new session. All right, here's what we got. Okay, here's what we got. I'm gonna go to the higher time frame here, and I'm gonna kind of be looking at what we're getting here. All right, so need to turn off these session breaks. I hate these. So it is. We're gonna go to next session. Next session. Okay, this is the. Okay, we gotta go to next session. All right, fine. Okay, this is gonna be Asia. Next day open. How about that? Okay, next day open. We're here. It is 2:30. Now, how would I find the draw on liquidity in this situation? Okay, well, what I just talked about. Now, I'm going to use my piano skills, put a bunch of different notes together, and I'm going to find you the draw on liquidity. Okay, who can already see the draw on liquidity? I already see it. It's very easy. Who sees it? Okay, how many confluences do you think we have to the draw on liquidity right now? Yes, just say a number. How many confluences do you think we got? Okay, for all of you saying 3, you're wrong. We have about 5 confluences to the draw on liquidity right now. Ready? 1, we have trendline liquidity here. It's not too steep. Trendline liquidity. 1, 2, 3. This would be B on the tier list. Okay, but we're going to combine that. What else do we have? We have a high inside of fair value gap. And you're probably like, that's not high inside of fair value gap. I bet you, if you go on the 1 hour here, I bet you it is. Okay, right here. There's an hourly high inside of fair value gap up here. It's a little different, but it still counts. So we have a high inside of fair value gap here. All right, combined with 4-hour trendline liquidity. What else do we have here? An unbalanced inefficiency. Right? Unbalanced here and unbalanced up here. Okay, we actually have 6. What else do we have? Volume imbalance right here. Okay, that's 4. What else do we have? Inverse right here. What else do we have? Order block right here. All right. And what else do we potentially have? Well, we have a giant leg up right here. So we could, there is a possibility of doing this instead of just doing this. And honestly, as traders entering the New York session, we probably prefer this to get like a dream scenario. Okay, like I love a dream scenario here, but I'm more leaning on just this happening, which you could still probably find a play, but you know, the draw on liquidity doesn't change whether we go down first and get a dream scenario here, which we could, or here. It doesn't matter. The dream scenario, the draw on liquidity is still up here. Okay, so let's just play out. And boom. As expected, I figured we just go up because we put in the order block. And we filled the volume imbalance, hit the hourly high side of the fair value gap, hit the trend line liquidity, hit the unbalanced inefficiency. Inverse pumped us up as I thought it would. And order block pumped us up as I thought I would. So when you put all the piano notes together, exactly how I just did, you will find A++ draws on liquidity instead of just using all of these combined, or all these on their own, okay? This is not gonna loan, this is not gonna loan, this is not gonna loan, this is not gonna loan. But putting these together on a piano, okay, exactly as I just showed you, you can play the notes. And that's where you find the good draw on liquidity. So that is gonna be it for now. I will see you guys later. Peace.